All right, hi everyone. Welcome to today's webinar brought to you by Vantage Markets. Right, take note we're streaming directly into the app, the Vantage app, as well as over Zoom. So do drop your questions in at any point along this during this webinar, right, in the respective chat boxes. All right, we'll be paying it. I'll be checking in on the uh, Q&A box on the Vantage app as well as over Zoom. All right, thanks everyone for tuning in. Right, now, before we get things going, please take note of disclaimer, right? The information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Advantage, and are solely used for educational purposes as they do not constitute investment advice and or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin, forex, and CFDs as they carry significant risks and is not suitable for all investors. Right, my name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between Vantage Markets and Empress Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so in today's session, we're going to have the spotlight on a central bank, and this central bank is, of course, the Federal Reserve. So we're going to look at some of the key takeaways that from the Fed statement that was released on the 12th of June. So the FOMC meeting took place about 2 weeks ago from the 11th to the 12th of June. And we're going to look at what the key takeaways from that statement, as well as was there any significant shift in messaging from Chairman Jerome Powell during his press conference. And after that, we'll try and synthesize all that information together and see what it means for the US dollar moving forward. Right, so here are some of the key takeaways from the FOMC meeting that concluded on the 12th of June. Right, as you can see here, 12th of June, the meeting statement was released along with the economic projections, as well as Chairman Jerome Powell's press conference at 6:30 p.m. So take notice, the GMT time statement was released at 6 p.m., followed by the press conference at 6:30 p.m. Now, with this particular FOMC meeting, it also had sort of a bit of special element to it in the fact that just a few hours before, about 6 hours before, US inflation data for the month of May was released, right? So you had CPI data that was released about 5.5 hours prior to the release of the FOMC statement. So it was a very eventful US session on this date. So as you can see here, when looking at CPI data for both core and headline CPI on a monthly basis as well as on an annualized basis, you can see the readings came in lower than their respective forecast. That means we had a softer than expected inflation data. So that usually would cause the US dollar to weaken, right? So remember, softer inflation data usually would cause the US dollar to get weaker. And then after that, we had the FOMC statement, which was released at 6 p.m., followed by the press conference by Chairman Jerome Powell at 6:30 p.m. GMT time. Right. So, of course, the key takeaway was the market was already expecting the Fed to keep interest rates on hold, which is what they did. They left it unchanged at 5.25 to 5.5% for the seventh consecutive meeting. Right. They kept it on hold. Remember, the Fed keeps its has a range when it comes to its Fed funds rate. It's not a fixed absolute number. It's a range that goes from 5.25 to 5.5%, and they kept this target on hold once again for the seventh consecutive meeting. Right. So one of the key takeaways was that policymakers do not expect it will be appropriate to reduce rates until they gain greater confidence that inflation is sustainably moving towards the target of 2%. Remember, uh, the Federal Reserve, along with other central banks, have a inflation target. And for the Fed, this target is at 2% on an annualized basis. Right. So part of this reason for this statement was because if we saw in the first 3 months of 2024, right, basically the first quarter of 2024, we saw headline CPI accelerate in the US. Now, this started to raise some concerns for Chairman Jerome Powell and other policymakers because markets had anticipated, I think, about 3 or 4 rate cuts in 2024. But because inflation started to pick up in the US, a lot of these initial rate cuts or projections for rate cuts had been significantly reduced, right? So there was a big change in the stance of the Federal Reserve as inflation started to reaccelerate in the first quarter of 2024. So that is why they had a very specific statement that they mentioned that they until they gain greater confidence that inflation is moving sustainably towards their target, they are unlikely to cut interest rates anytime soon. Right. Now, the dot plot is also a forecast tool that's shared by the Federal Reserve at each meeting. And for 2024, policymakers only see one rate cut this year, followed by two cuts in 2025. Now, in the meeting the June FOMC, before the June FOMC, the previous meeting was back in March, and back then, the Fed was forecasting three rate cuts in 2024, followed by another three in 2025. Fast forward to June, right, a couple of months later, you can see them backtracking on this initial forecast, right? So the forecast for this year now is just for one rate cut, followed by additional two rate cuts in 2025. Now, with regards to GDP projections, right, the Fed no changes or no revisions to GDP growth. So they see that the economy expanding 2.1% in 2024, which is this year, and 2% in 2025 and 2026. However, PCE inflation was revised higher. Remember, we had CPI data accelerate in the first quarter of 2024. And because of that, that has led to some changes in the forecast as well for PCE inflation, which has now been revised higher from 2.4% back in March to 2.6% in the June meeting. And for 2025, PCE inflation was revised higher as well from 2.2% to 2.3% in 2025. And finally, for 2026, it was kept unchanged at 2%. Similarly, for core PCE inflation, this metric was also revised higher for 2024 and 2025 as well, but kept unchanged for 2026. So you can see how the impact of the of higher CPI in the first quarter of 2024 has affected the Fed's policy stance, as well as their forecasting with regards to future monetary policy rate cuts or future policy rate cuts. Right. So the next meeting is coming up in about 4 weeks' time. So that's going to start on 30th of July and it'll conclude on 31st of July, where the statement will be released, followed by Chairman Jerome Powell's press conference. Right. So if you look at how the Fed funds rate currently stands at over the past 10 years, right, we can see a very sharp increase in the rate of the or in the level of the Fed funds rate. Of course, right, it was sitting at about 0.5% following the pandemic lockdowns in March 2020, and it has stayed there for a period of 2 years before, a period of almost 2 years before accelerating or being lifted strongly as the Fed and other central banks tried to combat or tackle inflation. Right now, following the press statement as well. So generally, you could see, okay, just coming back to the Fed statement. Generally, you could see the statement was can be summarized as being hawkish as well, right? You can see that until they gain greater confidence that inflation is moving sustainably lower, they're not going to cut rates. And at the same time, we can also see that by their forecasting for PCE inflation for 2024, 2025, and 2026, we can see that they're also expecting inflation to be quite stubborn as well in the next couple of years. Like that, moving forward to the press conference, which commenced half an hour after the statement was released. This was at 6:30 p.m. GMT. So we can see that these are some of the key quotes from Chairman Powell during his press conference. So naturally, right, we can see inflation has eased notably over the past 2 years. Remember, CPI inflation, I believe, if I'm not mistaken, was as high as about 9% year over year. But you can see at current levels, it remains above the longer run goal of 2%, right? The target is 2%. And the inflation data that was received earlier this year, basically, which was in Q1 of 2024, right? This was much higher than expected. But we are starting to see more recent readings have eased somewhat. So far this year, the data has not given us that greater confidence for the Fed to reduce rates. They will need to see more good data to bolster their confidence and to ensure that inflation is indeed sustainably moving lower towards their target of 2%. However, Chairman Powell was also pointed out that if the labor market were to weaken unexpectedly or if inflation were to fall much more quicker than anticipated, the Fed are prepared to respond accordingly as well. So although they have kept a more hawkish stance at this latest FOMC meeting, they are also letting market participants know that they are also going to be pretty flexible should sudden abrupt changes arise with unexpected changes in the labor market, level of the labor market strength, or in the level of inflation as well, right? So they're going to be data dependent, and that data could cause them to move quicker than anticipated as well. So they're trying to let markets know as well that they can be flexible if they need to be. Right now, this is the chart of the dollar index. I'm on the 30-minute time frame. Okay, remember that the FOMC meeting took place at 12 p.m. GMT time. The statement was released at 1800 GMT, which is this candle here, and the press conference commenced at 6:30 p.m. GMT, 18:30 p.m. 18:30 hours on this day as well. So this was a press conference, the candle for the press conference, and the prior candle was for the statement release. But also you can see this huge gap that occurred here as well. Remember, before the release of the FOMC statement and press conference commenced, we also had US CPI data for the month of May, which was released, right? So remember, the US CPI data came in softer than expected, right? So this was released at 12:30 p.m. GMT time. Remember, softer than expected CPI data is likely to cause the US dollar to weaken, which is what it did at that point in time. So this candle here is when this US CPI data was released at 12:30 p.m. GMT time. Right, CPI data here, and you can clearly see that there's a huge gap down on this index here. This was the USDX index on the Vantage that's provided by Vantage, right, on the app. You can see a huge gap down. Dollar index was trading at around 105.10 prior to the release of the CPI data, following which it gapped lower at 104.80 and proceeded to drop as low as 104.20. So you can see the impact or the volatility that this that financial markets experience or currency markets experience on this date, on the 12th of June, right? Remember, softer than expected CPI data caused the US dollar to weaken significantly, causing this gap in the dollar index here. And after which, as the statement was released, followed by Chairman Jerome Powell's press conference, both of which were pretty hawkish, caused a sudden reversal in the direction of the dollar index, and it literally reversed all the initial losses and made new gains as well for the day. So you can see how currency markets had moved on this day. There were wild swings within a period of about 5 to 6 hours, right? First of all, the CPI data, softer than expected CPI data, caused the dollar index to sell off very aggressively. After which we had this FOMC statement and press conference, which was projected a very hawkish outlook, which caused the dollar index to stabilize and reverse sharply and rise strongly as well. Right, now, what does it mean for the dollar moving forward? Right, so before we get to that, what can we expect the US dollar index to do? Right, let's take a quick look at the state of the US economy. Right, we'll look at a few factors. Of course, we can't go through everything, but we'll cover a few things like GDP, employment figures, PMI figures, and housing and consumer spending as well. Right. Okay, so looking at GDP on a quarterly basis, right, we can see that throughout 2023 and in the second half of 2022 and for most parts of 2023, the US economy was growing quite steadily, right? Economic activity was growing quite steadily, especially in the third and fourth quarter of last year. The third and fourth quarter of 2023, we saw GDP growth jump to 4.9% in the third quarter and increase to 3.4% in the final quarter. So a strong end to 2023 in terms of economic growth. However, when you look at the forecast or when you look at the results for the first quarter, GDP, it came in at 1.3%. This was lower than the advanced estimate, which was 1.6%, right? This was primarily due to a downward revision in consumer spending. But take note, the US consumer makes up almost 60% of US GDP output. So any significant decline in consumer spending is going to have a significant impact on the level of GDP output as well. So consumer spending and the labor market is signs that need, or metrics that need to be closely watched as well. So we can see here, although the economy is still growing, right, the rate of change, the rate at which it's growing has started to slow as well, right? And especially in the first quarter of 2024, this growth of 1.3% might be a little bit concerning as well, because it really started to see economic output taper off quite significantly here. Looking at it, looking at GDP on an annualized basis year over year, it remains pretty steady, right? With the latest result showing that the US economy expanded 2.9% year over year, slightly below the forecast of 3%, right? So overall, on an annualized basis, economic growth looks to be pretty steady, but on a quarterly basis, we can see that it has started to slow down quite significantly, especially in the first quarter of this year. Now, what's important is what's going to happen in the second quarter. Second quarter, I think the latest forecast are suggesting a slight pickup in economic activity. So if that were to happen, so that's great. That means we can expect the US economy to continue to chug along quite well. And then, of course, that would mean that we may see some strength in the dollar as well. That could translate to the strength in the dollar as well. Right, now looking at ISM, Manufacturing and Services PMIs. ISM is the Institute for Supply Management. They release two reports every month. One is for manufacturing and one is for services. A PMI is Purchasing Managers Index. It helps us, these reports track and give further insights into the level of manufacturing and services activity in the US. Now, looking at manufacturing PMI, right, a reading under 50, which is this green line here, right? This is the threshold for PMI. A reading under 50 indicates contraction for that particular PMI, and a reading above 50 indicates expansion. Now, for manufacturing, it has been in contraction for well over a year, with the notable change in March of this year, where we had a slight increase or slight return to expansion, but it was then followed swiftly by contraction in April and May again. So the manufacturing sector has continued to remain weak in the US, right, as highlighted by the contractionary figures of the PMI data. Now, on the other hand, services activity has been the sector that's been pulling up overall economic growth in the US. Here you can see that the threshold of 50 sits over here, and you can see for most parts of the year, or for most parts of the last 12 months, services PMI has been expanding very strongly, except with the exception for the result in April, where the data came in at about 49.5 to indicate contraction. However, if you look at it, overall economic activity has been strong, and services has been leading the charge, especially with May's number, right? It soared to 53.8, which was the highest reading in 9 months. And it was also well above the forecast of 50.8. So once again, the services activity or the services sector is pulling up overall economic activity in the US. Looking at the composite PMI, this composite PMI is released by S&P Global. This agency releases not only PMI figures for the US, but also for the other countries as well. So you can see here, in the first quarter of 2024, we can see that although PMI numbers were indicating an expansionary figures, right? Remember the threshold of 50 sits over here, this dotted green line. Although we saw a nice acceleration in PMI activity, composite PMI activity by S&P Global towards the end of 2023, we started to see that level of activity start to taper off slowly, although it didn't, of course, fall into contractionary region, but you could see the rate of change has started to slow down, giving some worrying signals as well, because especially with Q1 GDP falling quite significantly as well, there was some concern that this may have further knock-on effects. However, we're now starting to see in the second quarter of 2024 a strong rebound in global composite PMI, in composite PMI in the US as well. And also we're starting to see services, ISM services PMI pick up. So we're quite likely to see a nice rebound in GDP output for the second quarter of 2024. Right, so the PMI indicators are suggesting that we're going to see economic activity increase or rebound in the second quarter of this year. All right, now coming to inflation, right? So we have the BLS, which is the Bureau of Labor Statistics. They, of course, release inflation data points such as the CPI and core CPI, as well as PPI and core PPI. Now, one of the major concerns this year, or in the first quarter of this year, was this period here, right, where we saw headline CPI accelerate from 3.1% to 3.5% in the first quarter of 2024. Over the same period, we saw core CPI continuing to remain relatively stable before finally dropping lower in the last couple of months. Now, this region here is what raised concerns for the Fed, because prior to this acceleration in inflationary prints, the markets were anticipating 4 rate cuts for 2024. But because of this pickup in inflation in headline CPI, a lot of these forecasts were rolled back, and it also caused the Fed to adopt a more hawkish outlook as well. Now that we can see over the last 3 months, we have started to see headline CPI sort of stabilize and start to trend lower. Remember, it is still increasing, but it's increasing at a slower rate, which is good. We want to see the rate of increase on an annualized basis continue to trend lower. And should we see that occurring over the next couple of months, that means the Fed could very well, they may not cut rates at the July meeting, but the meeting after July is going to be in September. That's where a lot of forecasts is, that's where a lot of initial analysts are predicting that the first rate cut is going to come in at the September meeting. Right. So once again, to summarize, CPI data and core CPI data have started to trend lower in the recent months, which is a good sign for the US, and also it means that the Fed is quite likely to maybe ease back into July's meeting. They definitely will not cut at July's FOMC meeting, but they may adopt a less hawkish approach back then, and paving the way for a potential rate cut in September. Now, BEA is another government agency, which is the Bureau of Economic Analysis. They also released their own inflation metric, which is the PCE price index. PCE is personal consumption expenditures. Now, this metric is closely watched by the Fed. It is actually the Federal Reserve's preferred gauge of inflation. So similarly here, we can see headline PCE on an annual change, annual changes year over year, start to accelerate in the first quarter as well. And we can see what was a nice downward trend in the core PCE had actually started to stabilize as well. Although you can see the readings are well below their highs, but they're still elevated in the sense that it has not reached the Fed's target of 2%, right? Even when you look at headline CPI and core CPI, headline CPI currently stands at 3.3%. Core is at about 3.3 as well, I believe, or 3.2. Both of which are well above the Fed's target of 2%. And it's a similar story for when we look at the PCE price index as well. April's figure came in at 2.7%, and the core PCE for April came in at about 2.8 or 2.7%, both of which are well above the target of 2%, the Fed's inflation target of 2%. Now, looking at home prices as well, right, we can see initially home prices had decelerated throughout 2023. However, from the middle of 2023 and coming into the second quarter of this year, we have started to see home prices accelerate as well. That's also a little bit of a worry for the Fed as well, although we are seeing inflation, as mentioned by BLS and the BEA, starting to trend lower, but higher home prices is also another component or aspect of overall price pressures in the US, and this is also another concern for the Fed as well, right? So when you look at the 20-city home price index, right, as measured by the S&P CoreLogic Case-Shiller agency, you can see that US home prices surged by 7.4% here. This is 7.4% in March of 2022. This was the highest reading since October of 2022 as well. Right, so of course, higher home prices is also going to feed back into the CPI data as well. So this is also another concern for the Fed. So should we see home prices perhaps start to stabilize over the next couple of months and maybe start to trend lower? That's also another positive sign, which the Fed will of course take into account when deciding or when it's also another part of the puzzle that the Fed is looking at when it comes to finally coming to the conclusion of whether to cut rates in September or not. Right, then finally, as I mentioned, not finally, but as we come towards the end of this section, we can see consumer spending is another important segment of the US economy. Remember, the US consumer makes up about almost 60% or just slightly over 60% of total US GDP output. So on the left here, we have the month-over-month data for US retail sales. And on the right, we have the chart for the annualized data or year over year. So as you can see here, over the last 1, 2, 3, 4, 5, 6, 7, 8 months here, data has been slightly mixed. But what we are seeing here is slightly a lower some weakness in consumer spending in 2024, right? For most parts of 2023, of course, there were down months as well, but generally you could see there were strong gains as well in 2023. However, the strong gains have started to fade in 2024 as well, especially with January's number, which I guess can sort of be expected because after all the heavy spending during Christmas and Black Friday sales, we can naturally expect the consumer to not really come out with a bang in January 2024 in the new year because they've spent all of their shopping in the previous couple of months. So naturally, we can expect a much softer sales output or consumer spending in the first month of the new year. However, as we had moved forward, we can see that consumer spending has started to taper off. It's not as robust as it was in 2023. So this is also another worrying sign. But on the flip side, the positive side is if consumer spending starts to slow down, this also, of course, feeds back into inflation, because if there's less folks spending, right, prices for goods and services may start to come off as well, right? If there's higher demand, prices are likely to remain elevated for goods and services. But if demand starts to taper off, we are quite likely to see wholesalers and businesses start to reduce their prices as well, which then, of course, would then feed back into the overall closed loop of CPI prices. Now, on an annualized basis as well, we are seeing consumer spending start to slow as well, right? Of course, it is increasing, but it's increasing at a slower rate. It is trending lower. So this could all naturally feed back into softer CPI readings in the next couple of months as well. Now, of course, employment is another major factor. If we see strong employment accompanied with higher wage growth, that's of course going to mean we have a resilient American consumer, and that resilience can also, of course, feed back into consumer spending and then start that vicious loop of higher prices again. Now, looking at the unemployment rate, is starting to edge up higher quite noticeably, right? This level at 4% here, which was the unemployment rate that was registered in May. It is the highest level since January 2022. The unemployment rate throughout 2022 and 2023 had averaged between 3.4 and 3.7% approximately, but now we're really starting to see it pick up in a more meaningful way. Now, combined with non-farm payrolls, we can see non-farm payrolls has been pretty steady over the last 12 months, right? We have an average gain of 232 jobs over the last 12 months, which is this green line here. And as you can see, we have 1, 2, 3, 4, 5, 6, 7 months out of the 12 that have registered higher readings than the 12-month average. So overall economic growth or labor growth is still relatively strong, but there are pockets of concern, especially as we see unemployment rate tick higher, and also if we start to see unemployment claims continuing to climb higher as well. And of course, finally is job vacancies. We can see a drastic drop-off in job openings in the US in 2024. Now, of course, if there's less job openings, it means businesses and corporations are not looking to hire as aggressively as they were in the prior years. This, of course, does not automatically lead to job losses, but it just shows that the pace of hiring in the US has started to slow down quite significantly, which means the labor market is probably getting pretty saturated, right? So we may start to see non-farm payrolls adding less jobs over the next few months, especially if we see unemployment rate and unemployment claims start to edge up higher over the next few months. Right, so we can see that to just piece it all together, we can see job vacancies have started to drop off. That means US corporations are not hiring as aggressively as they are, indicates a sign of potential saturation in the US labor market. We are starting to see the unemployment rate pick up in a notable way, which could have an impact which may be reflected in upcoming non-farm payrolls as well, right? If companies are not hiring as aggressively as they were over the last 18 months, we are also likely to see non-farm payrolls, which are monthly job gains, start to taper down over the next few months as well. Then also that would also feed back into consumer spending, right? We are already starting to see on a monthly basis consumer spending starting to weaken, as well as on an annualized basis consumer spending starting to trend lower, all of which could cause the level of retail spending to drop off in the next couple of months as well. Home prices have accelerated over the last 12 months. Perhaps if they start to stabilize and drop lower, we're not too sure, right, how this can actually play out, because part of the reasons home prices being elevated is also an inventory issue. There's a very tight inventory levels for US homes at the present moment, which is what is also keeping home prices elevated as well. Despite having higher mortgage rates and higher home prices, because of the very relative low level of US housing inventory, it's keeping home prices elevated. Right, inflation has started to taper off in the second quarter of this year, right, following a sharp increase in the first quarter of 2024. Right, inflation does look to be trending lower once again, and PMI activity looks to be picking up in the second quarter of 2024, which of course would mean that we are likely to see Q2 GDP data rebound in a quite meaningful way, right? After declining in the first quarter of this year quite significantly, right? We might see a nice strong rebound in GDP output. So that brings us to the fact that we have a relatively strong labor market. GDP output is also pretty stable. So all of this doesn't point to a weak US doesn't point to a weak US economy just yet. So that means the Fed is very likely to maintain rates at current levels as well, right? Remember, Chairman Jerome Powell also mentioned that during his press conference, if they start to see a significant weakness in the US labor market or a significant drop off in the level of inflation, then that's when they may react much more quickly than anticipated. But for now, it looks like things are still chugging along pretty well. So that means July, I don't think we can expect a rate cut in July, but we can probably realistically expect the first rate cut to come in September of this year. Now, let's see on a technical analysis basis how the dollar index is trading, and try and see what we can expect moving forward. Right, okay, so here we are on the chart for USDX. This is the dollar index. I'm on the daily time frame. Remember, this week we also have the PCE price index that's coming up. Let me try and find that for you. Here we go. So we have the US PCE price index being released this Friday. Wait, this is not on. Am I on GMT time here? Let me see. Just make sure. Okay, wait. Let me put this on GMT time. So we can see here this PCE price index is going to be released this Friday at 12:30 p.m. GMT. On a monthly basis for core PCE, we can see it growing at a slower pace at 0.1% one month over month compared to 0.2% over the previous compared to the previous month. So if we do see a softer round of PCE data this Friday, this is likely going to impact the value of the US dollar. So in this case, it's going to quite likely cause the US dollar to weaken even further, right? So take note, if you do see softer PCE data come Friday, this is going to have a pretty huge impact on the level of the dollar, and we can expect the dollar to sell off, which means dollar index is quite likely to fall lower come Friday. Now, this website here is a CME FedWatch tool. It gives us target rate probabilities for what the Fed is going to do at each meeting. So as you can see, this is the target rate probability for the July meeting. Currently, the target rate stands at 5.25 to 5.5%, and there's an 89.7% probability that the Fed is going to keep rates on hold once again, right? So you can see for July, the target rate probabilities is once again predicting a no change by the Fed. However, if you look at the meeting in September, there's a 61% probability that the Fed is going to reduce the Fed funds rate by 25 basis points to bring it down from 5.25 to 5.5% down to 5 to 5.25%. So this is where we can realistically expect the Fed to begin the first rate cut in September of this year, especially if inflation continues to moderate lower over the next few months until we come to this meeting here. All right, okay, now these are the dollar index is currently trading at 105.13. Now let's try and establish some of the key technical levels for the dollar index and what we can expect for this week, and what are the other significant levels to watch out for in the next coming weeks as well. Right, okay, so we can see here dollar index hit a high of 105.54 last Friday. As it opened this week on Monday, it touched this level once again before reversing to drop lower. Right, so of course the first major resistance that I see for the dollar index is at 105.51. This is where I would identify the first resistance for the dollar index. We can see this index running into resistance here back in May of the second week of May earlier this year, making a swing high resistance here. Then we can sort of argue as well, it's sort of running to resistance here in mid-June as well. And of course, running to resistance here last Friday and Monday yesterday as well. So you can see it very clearly. This is a very significant resistance level here. We can identify this as a pullback resistance level at 105.51, which we are going to identify as or label as the first resistance. Now, the second major resistance for the dollar index comes in at this multi-swing high here. You can see back on 16th of April and the 1st of May, we can see the dollar index making a double top here, right? A nice double top before finally dropping lower here. So these are very significant resistance areas as well for the dollar index. So we're going to use 106.30 and label that as our second resistance. Now, what about support? Right, there's a pretty decent pullback support level here at 104.68. Yes, although I do see this long wick here, right? The bottom of this wick dropping as low as 104.21. But generally, you can see when you look at the body of the candle, the daily candle here, you can see on 12th of June, 13th of June, as well as 18th and 19th of June, the dollar index has managed to remain above this level. So this is a pretty significant support level as well. You can identify this pullback at 104.68 as our first support. And when I look across this level here, at 103.86. This is also another significant support level here. We can see a nice pullback taking place here on 26th of March, following like by a double bottom as well, 4th of April, 9th of April before dollar index bounce higher. We can also see another nice swing low bounce on the 16th of May. We can also see another nice double bottom here, 4th of June, 7th of June before bouncing higher. So you can see very significant bounces of this level here at 103.86. It's a very significant pullback level or a multi-swing low support level, and we're going to identify this this level at 103.86 as our second support. Right, now that we've identified the major or the significant resistance and support levels, we can start to add some Fibonacci retracements to our analysis. Right, the first of which we're going to start from here, this swing low on the 8th of March, going up to the swing high here on the 1st of May. I believe there's a 61.8% that's currently in play. Right, yes, we can see that this 61.8% Fibonacci retracement on this uptrend here aligns very well with the multi-swing low that we've identified as the second support. There's probably one more Fibonacci retracement that we can add as well, starting from this swing low here, 28th of December, going up to the swing high here on 1st of May. Might be the 38 and 50. Okay, we've got the 38% as well. You can see the 38% as well, aligning quite well with this multi-swing low that took place on 16th of May and of course on the 5th of June as well. So let's just keep 38% here. It's 38. But there we go. All right, okay. And then just highlight this as a zone over here. Now we can also add another retracement, starting from here, this swing high on the 1st of May, going down to the low. The absolute low is here on the 4th of June. I believe there's a 61.8% that we can use once again. Yep, you can see the 61.8% Fibonacci retracement aligned very well with the first resistance, right? This adds additional significance to this level over here. And there's a final retracement that we can add, which is from here, this low on 4th of June going up to the high of last Friday. We can once again see that this pullback support level at uh, 104.68 also has the presence of a 61% Fibonacci retracement just below it here. Right, so you can see these are the key levels for the dollar index moving forward, and especially if we do see a softer than expected PCE data coming up on Friday, we're likely to see the US dollar index lose even further ground, and we may potentially see test this 61.8% Fibonacci retracement and perhaps even break below the 61.8% Fibonacci retracement if we do see a much softer than expected PCE price index reading. And that means we could potentially see the dollar index drift lower towards the second support over here at 103.86. Right, so these are the key levels for the dollar index on the daily time frame. And also I would also like to point out, I do see a nice ascending trend line as well here. I do see a nice ascending trend line. Right, let's just zoom in a little bit here. So you can see since the 6th of June, as the dollar index started to climb higher, this trend line has functioned as a pretty strong support level as well. You can see it bouncing off this trend line here on the 12th of June. Even here, we can argue 18 and 19th of June has sort of touched this level to bounce higher. Again on 20th of June, and of course, as recently as Monday and today as well. So you can see this trend line, this ascending trend line is still intact, and its function has as a pretty strong support level for the dollar index as well. Now, of course, if this ascending trend line gives way, then of course that's going to trigger a much stronger bearish move down towards the first support at 104.68, right? So take note of that as well. And for now, we see prices being supported by this ascending trend line, but any clean break underneath this level is likely going to trigger a stronger bearish downward action for the dollar index here. All right, let's cover a couple of the majors as well. So we can let's do the analysis on the euro, and perhaps at this time we'll cover the analysis on dollar yen as well. Now remember, the dollar index is basically an index that measures the value of the strength of the US dollar versus its peers. So this basket is made up of about 50% of it is the euro, and about another 15% is the Japanese yen. So you can see the euro and the Japanese yen make up almost 60-70% of this basket. So naturally, if you see the dollar index rising strongly over this period from 6th of June till now, we're also, of course, expecting to see the euro fall down strongly as well. So remember, the euro makes up almost 50 or 55% of the dollar index basket. So naturally, if you see strong demand for the dollar and you see the dollar index rising very strongly, of course, the euro is also going to be falling sharply as well, right? Which is what we are seeing over the same period, right? 6th of June. Right, over this period, 6th of June, okay, let's just say first week of June till now, you can see the euro in a downward trend. Similarly here, 3rd of June, 3rd of June till now, you can also see a nice upward trend for the dollar index. Okay, let's try and now focus on the euro. So now we can see the euro has found nice support here at 1.0680 since last or 2 Fridays ago, right? So I'm quite inclined to identify this level here. This is a nice pullback level that took place on the 30th of April. Then we can see the bottom of this wick coming quite close to 1.0664. And also, again, last Friday, we see the bottom of this wick coming quite close once again to this pullback support level here. So quite clearly, this is the first major support for the euro. And we see a nice swing low taking place here on 16th of April, right? We see a very nice swing low price action here. Market structure shows a very nice swing low. And then naturally, of course, this is the second major support area for the euro. So we're going to identify the second support at this swing low, which is at 1.0618. Now, looking at resistance, right, we do see the euro failing to break above 1.0750 convincingly since to last Tuesday, right? Exactly for a week. This level here has functioned as pretty strong resistance. So I'm quite inclined to label this level here, 10744, as the first major resistance for the euro, which is where we see it running, stalling as well. It stalled yesterday and it stalled today as well at around this region here. Right, and the next resistance that I would probably see where it could come in is at this pullback here at 1.0810, where this occurred on the 12th and the 13th of June. This is where I think the next resistance could come in for the euro here. Now we can start and add some Fibonacci analysis to our Fibonacci retracements to our analysis. First of all, I'm going to start on this downtrend here from this swing high, 4th of June, going down to the low here on the 14th. Right, let's pull up all the fibs. We can see that 38.2 and 61 aligned quite well with the first and second resistances. So let's just keep these two on and then highlight them as a zone over here as well. Yeah. We can also add one more retracement starting from this swing low from 16th of April going up to the high here on the 4th of June. I believe is a 78.6 that we could potentially use. Yes, there we go. The 78.6% Fibonacci retracement aligns very well with the pullback support here at 1.0664. Right, so these are the key levels for the euro as well. So take note, if we do see demand for the dollar continuing to get weaker, right, we may potentially see a break through this first resistance zone, right, where the 38.2% Fibonacci retracement sits, right. If we do see the US dollar continuing to get weaker in the second half of this week, we're quite likely to see the euro break through this immediate resistance zone, and then it could potentially rise up towards the second resistance here, which is bounded by the 61.8% Fibonacci retracement here. Right, is there anything else that I would probably like to identify? All right, yes, there's also a nice where is it? Descending trend line, right? You can see a nice descending trend line taking place as well here. You can see the euro has failed to break above this descending trend line since the 4th of June, 5th of June. So of course, if we see the dollar weaken significantly, we may get a bullish confirmation as well, but especially if the euro can break above this descending trend line and break above this resistance area that's bounded by the 38.2% Fibonacci retracement, that's very likely going to provide us with a very bullish signal or bullish technical signal, and we may see the euro continuing to climb higher following up this bullish breakout over here. Remember, the strong bullish zone of strong bearish zone that's bounded by the descending trend line, the 38.2% Fibonacci retracement, as well as the pullback resistance at 1.0744, all of which, if we see price break cleanly through this level here, we will get a high probability bullish breakout signal, and that could potentially mean we're going to see the euro continuing to rise at least towards the second resistance, which is at around 1.0810. All right, okay, so this is what I have for today. All right, so thanks for everyone for tuning in to today's session. Right, take note, we've got the next FOMC meeting coming up on the 30th and 31st of July. The statement will be released on 31st July along with Chairman Jerome Powell's press conference. For that meeting that's going to conclude on the 31st, there is a pretty much 90% probability that the Fed is going to keep rates on hold once again. And of course, for this next meeting, which is up on, which concludes on 18th September, there's a 61% probability that the Fed will indeed initiate the first rate cut, and they'll likely to cut it by 25 basis points. And of course, if we do see incoming inflation data continuing to trend lower over the next couple of months, then of course, this probability here is quite likely going to increase as well. Right, I'm just going to drop the the link for this website in the chat box as well. You can head on over to this website and check it out at your own pace, at your own leisure time as well. Right, before we wrap up today's session, for those of you who are on Zoom, I'm just going to launch a poll here. I'd truly appreciate it if you guys can give your feedback with regards to today's session. Right, just leave the poll running for about another 30 to 40 seconds, and then we'll call it a wrap. All right. Okay. Thanks everyone for the feedback. Right. Truly appreciate it. All right. Thanks everyone for tuning in to today's session. Do look out for all upcoming webinars brought to you by Vantage Markets. I wish you all a great trading week. And yeah, wish you all the best in your trading journey. And I'll catch you all at the next webinar. All right. Thanks everyone. Take care.